Today, the cash con and the news gods. Hello again, it's Martin North from Digital Finance Analytics, one latest post covering finance and property news. Today, we look at the latest on the war on cash, ask why banks are behaving so badly, and what the real story is. The bottom line is this: cash remains a critical element in the economy, its usage is growing, not shrinking, and you're being fed a line by the banks and by the media. Once upon a time, a bank used to take money from people with cash to spare, depositors, and lent it to people who needed a loan, borrowers, allowing the bank to take a turn or margin on the difference between the interest paid to depositors and interest charged to borrowers. Interest is essentially the price of money. In addition, they will provide a range of branches for people to interact with the bank, to provide a range of services, including access to cash and taking in cash deposits, including from businesses. A critical part of this was the management of cash, including its transportation and storage. It was just a cost of doing business, and all was well with the world. It's not commonly known, by the way, that depositors, when they place money on deposit, are in law unsecured creditors of the bank, something to bear in mind amid the fears of deposit bail-in, which was snuck in under international direction a few years, just be converted to equity in a failing bank to keep it afloat. But then, marketeers got the reins of the banks and stepped up the cross-selling of more products and services to direct customers. Often, they would embed hidden fees and charges, such as, for example, insurance on credit cards, sometimes automatically added to the product. They reduced loan buffers and pushed larger mortgage loans on people who were eager to ride the property wave at any cost. Banks became more reliant on mortgage lending for their profitability, as shareholders became more demanding on bankers to perform for them. Merchant bankers got to assist the banks with financial engineering, where they started to securitize or sell off their loans to investors. Remember the tie-up between Aussie Home Loan founder John Simons and Macquarie? And these same merchant bankers also encouraged the banks to make market bets on the trajectory of the financial markets. In the US, the division between speculative banking and core retail banking, known as Glass-Steagall, which was a vital protection for depositors, was thrown out. Merchant bankers and retail bankers merged into a single risk-laden entity. Management accountants taught them to unbundle all of the costs of revenue elements in their business to avoid cross-subsidization and to make it easier to embed more fees on customer-facing products and services. Their trick, by the way, was to load up costs using activity costing to services that they wanted to make unprofitable. The whole process is actually less scientific than presented, but gives banks carte blanche to justify charges equivalent to well-wounded bulls. It's a con. Ask me how I know. And technology has enabled digital services to become viable for the banks as an alternative to branch transactions and even cash itself, to the point where bankers have declared a war on horrible, expensive-to-handle cash, leading to closed branches, ripped-out ATMs, and people being led by the nose into a digital future which hangs by a technological thread which is cut when the power goes off. Last year, I was instrumental in getting the Senate inquiry into regional banking off the ground, and the hearings across the country brought into sharp focus the dire consequences of branch closures of people, especially in regional areas. The report recommended that cash be safeguarded in the community and offered some solutions to achieve this. Now, it's been quite quiet on this front until recently. Last month, Treasurer Jim Chalmers said Australia will mandate businesses selling essential items such as groceries and fuel to accept cash payments, joining countries from Spain to Denmark amid the growth in more preferable digital payment methods. He said that while around 1.5 million Australians still use cash for more than 80% of their in-person payments, the number of businesses accepting them has shrunk. The changes were designed to ensure that people weren't left behind, he said, while outlining the government's plan. We're making sure that people can pay cash for essentials if they want to, and if they need to, Chalmers said at a press conference in Canberra. Cash can be a really important lifeline. Like many other nations, Australia has been moving away from cash payments in favour of digital transactions, with selected Reserve Bank data showing that the use of banknotes for transactions is down. Meanwhile, the value of mobile wallet transactions in Australia hit around 93 billion Aussie dollars in 2022, which was up from $746 million in 2018. That's a significant surge, according to analysis from the RBA. But like I said, selective analysis. You see, actually, the rising volume of total transactions belies the fact that cash transactions are also on the rise, partially because more people are now aware of the benefits and convenience of using cash, no surcharge fees, and always on when the power goes off. And there is a rising trend of younger Australians using cash to manage their finances, using different pots for different purposes. And incidentally, youngsters get a much better feel for money and the concept of value when they use the physical stuff. Credit cards can appear like magic fairy money. Actually, the latest Reserve Bank of Australia balance sheet data reveals a surge in the value of Australian banknotes since August, with the number of notes on issue jumping $300 million in the week ended October. The figures did dip in July and August and continued to decline early September, but then rose rapidly from September the 11th. Jason Bryce from the awareness group Cash Welcome said the numbers are proof more and more Aussies are turning to physical cash as a reliable and easily available means of payment. He said this was despite Australia's banks continuing to restrict access to cash by shuttering branches. Mr. Bryce accused big banks of regularly leaving towns and suburbs without a plan to access cash, urging them to stop the closures and to rethink their approach. Retailers are not set up to provide people with their payday cash through FPOS cash payout, Bryce said. The RBA surveys shows that lower income, older and regional Australians are more likely to use cash. But it's also in these groups that cash use has declined most in recent years. Cash use has declined the most in those over 65 since 2019, from 52% of transactions to 27% of transactions. But the trend is similar across all age groups, and debit card use overtook cash sometime between 2016 and 2019, and now accounts for more than half of payments. Credit card payments also displaced cash during the COVID pandemic. Half of those surveyed in 2022, that's the latest data available, did not use cash at all in the week, up from just over a third in 2019, and 5% used cash for all in-person transactions in 2022, compared to 10% in 2019. Privacy and security were the biggest reasons to use cash, according to survey respondents, who said it would be difficult if shops stopped accepting it. Other reasons included disability, not having another way to pay, and poor internet access. There was a large increase in the share of people citing privacy and security between 2019 and 2022 surveys, and a large drop in those saying that there was no other way to pay. Australians actually most commonly use cash for leisure activities such as eating out and gambling, and for services such as hairdressers and babysitters. Transport has undergone the biggest decline in cash use in recent years, due in part to the rise in ride-sharing and public transport payment cards. But I want to underscore again that the number of transactions overall are rising, and whilst the proportion that are actually cash-related might be dropping, the absolute number of transactions is still rising too. Now, that's hardly ever reported in the media. And by the way, in Australia, there is currently no legal requirement for businesses to accept cash, and the final details of the government's plan won't be announced until 2025, and the new mandate will begin from January 2026. The government has not laid out what constitutes a business which provides an essential service, or what would qualify a small business for an exemption. Now, this is to me a weak and partial response from the government, perhaps reflecting the fact that the banks pay both major parties by way of donations and have major lobbying power. Many think politicians of all persuasions fear the banks, and they hold the real power. A public bank offering services via Australia Post branches would, for example, be a healthy competitor and force banks to lift their customer service game. Incidentally, Chalmers also said that the government would still move ahead with its plan to phase out cheques, which will stop being issued by the 30th of June 2028. They will no longer be accepted from September the 30th, 2029. But then, last week, we got a doozy of a story from the CBA. Yes, the same CBA who, in the regional banking inquiry, committed to not closing branches and to make cash available, a service that they estimated cost them around $400 million each year. They announced that they planned to charge for cash withdrawals. Specifically, in an email to customers from last Tuesday, CBA said that it would migrate customers with complete access accounts to the bank's newer Smart Access account. While the new account would have incurred a cheaper monthly fee at £4 rather than £6, a $3 fee would have been charged when a customer withdraws money over the counter, at a branch, over the phone, or at a post office from January the 6th, 2025. There was a massive reaction to this very silly move. I found it amazing that CPA was so cack-handed, although the Australian Banking Association's Anna Blythe trotted out the normal platitudes about people were going digital and the era of cash is passing, despite the evidence. Critics labelled the move as greedy, with Finance Minister Katie Gallagher urging the bank to reverse its decision. This type of charging and looking at $3 per transaction, I think it's really hard, and particularly for those customers that have those types of accounts and want to go into the branches, she told ABC News Breakfast. Housing Minister Claire O'Neill was also critical of the fee, saying the government believed that it was unfair to Australians already struggling ahead of December the 25th. Everyone's had a bit of a tough year on the cost of living front, and the last thing they need is a kick in the guts from the Commonwealth Bank right before Christmas, she said. We really want them to reconsider this. It doesn't seem fair or appropriate, and this is a huge bank making huge profits. Come on, guys. We don't need this right now. And in fact, pressed by host Nat Barr, if the government would get on the phone to the bank's bosses to do something, Ms. O'Neill said it would try to ask them to reconsider. Shadow Finance Minister Jane Hume, who is a customer with the CBA, described it as a greedy and an out-of-touch idea by the bank's executives. It's ridiculous, and customers will speak with their feet. There is no doubt about it. Including myself, actually. I have a Commonwealth Bank account. I've had it since I was at university. I'll be shutting it because of this decision, she said on Sunrise. But just a day later, the CBA said that it would delay its plans to charge a $3 fee for cash withdrawals after the backlash from both customers and government. By Wednesday afternoon, CBA's Retail Banking Services Group Executive Angus Sullivan said that the bank would review its approach to the changes, conceding that the bank did a poor job of communicating. We are particularly conscious of the impact any change to planned fees and charges can have at this time of year, especially given the cost of living pressures our customers face, Sullivan said. That, though, was an absolute train wreck of a press conference where journalists seemed incapable of unmuting their phones to ask sensible questions, and the bank said that 90% of customers that it wanted to migrate would have been better off or the same given the reduction in the monthly fee. For the remaining customers, CBA said that it would be pausing the migration and would contact the remaining customers who might be worse off over the next 6 months to discuss the most appropriate product for them. So they really hardly conceded anything. This unfortunate chapter of accidents has reignited broader discussions about the future of cash and the role of banks in providing essential financial services. Critics argue that banks should prioritise accessibility and affordability, particularly for vulnerable customers who may struggle with digital banking. Julia Agresso, National Secretary of the Finance Sector Union, said that CBA's backflip confirms the need for stronger regulation on banks, especially to recognise that accessing cash is an essential service. The Commonwealth Bank should never have decided to charge such a greedy fee, especially during a cost of living crisis, with high interest rates and rents hurting, and with Christmas around the corner, she said. While CBA prided itself on maintaining the largest branch network, it's actually copped criticism over closing 354 branches and removing 2,297 ATMs over the past 5 years. This has made it increasingly difficult for CBA customers to access free cash withdrawal services. Concerns have also been raised from the reliability of digital banking. A technical glitch in October caused some CBA customers to be charged twice for their transactions, further fueling fears about the growing dependence on online services. And while the government has made moves to ensure it's mandatory for businesses to accept cash for essential items, the fears of a cashless society are stoked when institutions make it harder to access cash. You have no choice. Yet another way to make you go digital, said one Facebook user in response to the cash fee. Voiced their dissatisfaction by threatening to switch banks, although options actually are limited as other major banks have similar policies. For example, ANZ charges $2.50 for staff-assisted transactions, while NAB and Westpac already charge $3. Excluding CBA, the other three members of the Big Four have closed close to 1,092 branches since 2018. It's also not just the major banks that suffer from the challenge of digital banking. A Reserve Bank of Australia report recorded 532 online banking outages over almost 3 years. So don't try to pull the wool over our eyes with a 6-month pause on charging customers to withdraw their own money. Perhaps real people are living in a different world to the executives at CommBank, but people blowing up about the fact that they'd be charged $3 for someone to hand them their own cash was, well, entirely predictable. That CBA bosses didn't see that and are now blaming it on the fact that changes are difficult and that they've decided to announce a change in our approach is emblematic of the arrogance of the big banks. This is a business that turned a $9.8 billion profit for the 2024 financial year. And we're supposed to believe that a teller handing you some cash is such an expensive exercise that you must be charged $3 every time you do so? Cry me a river. CommBank has closed more than 350 branches in the past 5 years, apparently because people don't want to go into them anymore. But that, of course, is not the true story. It's ridiculous to charge people to access their own cash. Banks, sure, are businesses and should charge as they see fit. Fair enough. So go to the ATM instead, except, of course, that they've closed around 2,300 ATMs at the same time. So it's all well and good to say fewer people are using branches, but there are some things that require you to go into a branch. Recently, there was a case where a customer was required to go into a branch to be issued with a debit card on a business account. Couldn't do it online. The use of and access to cash is a human right, and it needs to be preserved at all costs. Yet the government is still cozying up to the banks and still give them too much rope. Access to cash and the use of cash must be preserved. And no, RBA Governor Michell Bullock, this does not mean customers should pay to access their own money, as you floated in a speech last year. So to conclude, the truth is that banks want to take cash out of the system because it costs them money, but it is a cost to them of them doing business for you. You shouldn't be charged to access your own money. But more broadly, the truth is that the use of cash is still pervasive across society and is actually rising at the moment, despite the fact that the transaction volumes relative to the growth in digital transactions is not rising as fast because, of course, more transactions are going through the system as it's more convenient to pay for digital stuff. And I'm afraid that government here is not doing what they should be doing, which is looking after the interests of people. That's why I believe that the idea of a public bank that actually can compete with the commercial banks would be a huge raging success. Many people would shift their transactions and deposits to such a bank. And by the way, it would provide a platform more broadly to help reinvigorate investment in Australia. It's a no-brainer. So the question you need to ask yourself is, why is it that government is resisting so hard? And the reason, of course, is they are captured by the banks. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.